Let's talk about that market reaction, because I think that might be a bit surprising, maybe perplexing to some of the viewers there. We want to bring in Steve Sosnick. He's Interactive Brokers Chief Strategist, also Joe Brusuelas, RSM's Chief Economist. Steve, just to go to you on the market reaction, the fact that this print came in a little light, 151,000, again, unemployment rate rising to 4.1%. Why aren't we seeing more pressure on equities right now?
What we've seen isn't enough for you, Seana?
I don't know. There's lots to talk about. If it were to be a miss in any regard, then we could maybe see a further swing to the downside.
My reaction when I saw the numbers was this was close enough. Yeah. We landed the plane, maybe it's a little bump on the landing, but it was fine today. And I think that's what you're seeing now is a bit of a relief rally. We've been under so much pressure. We still see customers who just are eager to look for a buyable dip, and they've been quite disappointed in trying to find them. And so I think right now what you're seeing, at least for the morning, at least the initial reaction, is a little bit of a sigh of relief, and the sigh of relief is allowing some buyers to step in.
How far do you think this goes to the upside today?
Depends on what the news flow is. I mean, literally, we've been buffeted by news flows. I think, I think some of what we've seen is interesting. We have seen these very, very big FOMO-driven rallies. They can get extended on Fridays because of weekly option expirations.
Sure.
You have the daily expirations in the index futures, but 600 and over 600 other products expire today. You run through some strikes. You can extend a move in either direction. So let's see if the good feelings persist. But I wouldn't be surprised to see just sort of like them trying to gun it later if it's all been quiet.
I also want to note the revisions here for December, up by 16,000. For January is actually revised down by 18,000. Not too much of a movement there, netting out just 2,000 lower. Joe, when you take a look at this print, combining the average weekly hourly earnings that we're getting as well, the year-over-year move that we're seeing, is it a solid print in your view?
It's a Goldilocks print for the context in which we are living right now at this moment, at this second. Market's going to look right through this. We know that over the next 3 to 6 months, we're going to see some of the disruptive effects in Washington start to show up in both the economy and in the labor market. But for now, what this tells us is that, we really only need to add about 100 to 150,000 jobs a month to keep employment stable. That's exactly what happened. The acceleration in wages last month was due to work hours. That was a statistical mirage. The fact that we reset back to 0.3 and we're looking at 4.1%, all of that's pretty good. Now, we got to dig into the detail. I was able to see that the BLS said that the fires in Southern California had no discernible impact on this report. We do want to see how many people weren't working due to the bad weather, and I think that's going to be quite large. As we move forward, though, guys, you should expect hiring to slow to somewhere between 100 and 120,000 per month, which is, again, more than enough to keep the unemployment rate stable. And that's got to do with probably state and local government pulling back on hiring because of the uncertainty around cash flows from the federal government to the states. That's going to be a bigger part of the ongoing story going forward. But we really got to dig into the detail here to see what the private sector did.
Well, what's interesting about that is I just wanted to tell our audience that we do have federal government payrolls falling by 10,000 jobs month over month. So I guess the market might see that and think, okay, well, that's why we had the miss of 160,000. That's about 10,000 jobs there. But how bad do you think the jobs numbers could get once we do have the full impact of those DOGE cuts priced in?
They're not going to be bad. We have a very tight labor market. Labor imported from the external tech sector has slowed basically to zero. So you're just not going to see a surge in unemployment because federal government hiring slows to zero or cuts. I had 160 today on my forecast. Had 4%, 0.3, 4.1. You want to know why I missed? That federal government hut, right? That's exactly why.
I gave it to you, Joe.
Yeah, you did. I'll take it, Madison.
Yeah, when you take a look at some of these other sectors as well, healthcare adding 52,000 jobs during the month, financial activities adding 21,000, transport warehousing adding 18,000. I guess, Steve, the question is whether or not this is enough in order to not only regain some of that lost momentum, but keep that momentum. And I know you were saying much of that's going to be driven by the headline news and what we get throughout the day, obviously, in coming days and weeks and months. But how are you thinking about how large of a sell-off we have had, the fact that the NASDAQ is in correction territory? Maybe this is enough to spark some of that buying activity.
It can be. I mean, certainly a lot of the metrics, the technical metrics show us being a bit oversold. But it's different when there's sort of news flow. This wasn't really just sort of like let's give up a little bit of the gains. There has been some news flow. One of the other issues you see is I think there is just a general sense that the economy is not as strong as people had hoped or thought it was. Remember, about 6 weeks ago, the talk was for one rate cut in 2025. Now we're looking at 3 or more. And so there's a big change there, and stock markets do ultimately react more to the economy than they do to the rate cut picture. And I think that is one of the things we have to work through. I think people want a little more clarity on the state of the economy, because I think people got a little spooked.
I would think that this would take some of that pressure off the Fed.
It certainly does. And I think my fear actually is more that the Fed is slow to react, because I think the Fed is waiting to see really the full effects of the federal government moves, whether it's tariffs. How are they supposed? If we can't plan, they can't either. And I think there is the risk that the economy slows faster than the Fed is able to react. That I'm not saying necessarily is the base case, but I think that fear has entered into the market and is weighing on things a bit.
I think there's some evidence of that slowing in this print too. When you take a look at the U6 underemployment rate soaring to 8%, the highest level since October of 2021. Joe, I know you're looking under the hood at some
Yeah,
of
and
the
there's a
data.
reason why that happened, because 1.3 million people who are working part-time and looking for work weren't because of the weather. Another 404,000 again who were normally full-time workers just weren't working. This actually probably understates the strength of the labor market, to be honest with you. So when I see the market setting up for 3 rate cuts, Steve, I'm thinking maybe not, guys.
Okay.
Yeah, we'll have to wait and see what the tariffs do on the margin. I mean, we're hearing from corporate CEOs, they're going to pass prices through quite quickly. We're not going to see the same reaction function out of the corporate sector that we did in 2018. Yeah. They're moving, and in many cases, they're hiking prices ex ante, even before they show up.
Well, Joe, how disruptive should the markets be thinking tariffs are going to be?
25% serious number. We shouldn't. We should take that both seriously and literally. The CEO of Ford, I think, was right. It would blow a hole in their business, right? Mm-hmm. Which is why it didn't happen. I'm encouraged by that, right? We don't have to engage in Trump bashing here. Mm-hmm. They didn't do it. We'll see where we get next month. Of course, none of us like that. You know what my clients really want to know? They want to know what the darn rules of the road are going to be, so they can hire
everyone
people
wants to know that.
and make investment. I think at one point, Scott Bessent and the economists inside the White House, the logic of this will prevail. But it's just going to be a while. I'm enjoying riding the volatility machine every day, guys. It's quite something. No, seriously. I've gotten back in touch with a lot of my quantitative framework, and we can see the market was very offsides this week. The positioning across asset classes, and we paid a price for it, right?
Yeah, and that's I think the key here is, I think everybody's waiting for the clarity. Uncertainty produces volatility. I'm an option trader by heart. I love volatility. I live for this. But it does. Not everybody does. But investors can't stand it. You have to sort of have a certain mindset and a certain training to be to enjoy this. But I think that what you're saying is very true. I think Bessent. But it's even there, the focus on the 10-year is tricky for a lot of people because it moved the goalposts. We came in to the administration thinking that the prior Trump administration was very focused on the stock market. Now we're supposed to focus on bonds, and one way, as you know, Joe, is to get bonds down. If you want a bonds rates lower, the economy, a bad economy, will do that too. So you got to be careful what you wish for.
The interesting thing is that we clearly are in a late cycle slowdown. Right? We're having a classic growth scare. The corporate sector is very sensitive to the 5-year yield, the public to the 10-year, because that's a benchmark for mortgages and credit cards. When I see what's going on and I think, okay, this is a legitimate growth scare. M&A activity in January was down 30%, even though yields fell. That's not what you want to see. You would expect to see the opposite. Therefore, they're going to have to, at one point in policy land, get out in front of this and say, here's what the rules of the road are, and then they're going to have to stop.
Unless they want economic weakness, which some...
Well, I understand that that's a very counterintuitive talking point. When I watched Bessent this morning, I see real reticence about talking around inflation and where the 10-year is. That, to me, doesn't seem like they want the economy to slow down. Yeah. I like this administration. They have very easy tells. When the big actors start to talk, whether it's Howard Lutnick or the Treasury Secretary or the Vice President, you can see what the tell is.
Yeah. All right, guys, we've got to leave it there. Thank you both for joining us on our special coverage. Always appreciate it. Steve Sosnick and Joe Brusuelas, thank you for joining us.